Here now to help us wrap up the day and the week is Chad Morganlander, portfolio manager at Stifel Nicolaus. The firm manages more than $110 billion in assets. Chad, thanks for joining us.
Thank you for having me.
Let's start out with the issues today, and it's really been about commodities actually all week. Let's say all week. What is your view on commodities going forward? It seemed to get started up with the CME raising margin requirements for silver, but it brought down the entire sector.
Well, Matt, this is a synchronized trade. The dollar got a bid underneath it. There were a lot of dollar bears, and they had to have reverse that trade. So therefore, as the market started to get synchronized, you had a sell-off within the commodity complex, as well as a sell-off within risk assets.
You're still, though, operating on risk on here, right?
Yeah, I'm modestly tilted towards risk. 70% of our indicators, from credit to the economy to foreign indicators, are gliding in the positive, persistent direction.
What are you looking at as the most important indicators here? I mean, we've had a good add to jobs as far as the non-farm payrolls number, the monthly number, but weekly claims have been running up around last November's highs.
Well, that's been a disaster. The weekly numbers at 437 indicates a recessionary trend. In order for there to be a non-recession or considered a valid trajectory on employment, you'd have to have a 300K number.
What about the Fed? I mean, the inflation data today doesn't tell us really that much about what the Fed's going to do, but we hear QE2 is going to end soon, and it doesn't, at least the Fed hasn't telegraphed any QE3 or even QE 2.5 coming. What does that say for the markets?
Well, as a pivot to a neutral type of stance, you're going to see, I believe, the long end of the yield curve continue to go lower, as well as you may see credit spreads start to widen out all across the quality spectrum.
Let's get into the stocks that you guys like in this atmosphere. One of them I want to start with is Gap, because as people pay more and more money for gas, and we all know that this clothing company has had its issues, internal issues. Why do you like this company here?
Well, Gap is trading at about 10 times free cash flow. That's after tax to enterprise value. So therefore, they're going to continue to buy back their individual shares. They have had a muted type of top-line growth for the time being, but free cash flow has been well in excess of $1 billion, even the worst of times. So you have a company you're buying at about $12 billion enterprise value. That's a really terrific free cash flow yield. We
talk about these big quality names. Jules, you want to focus in on Chad's one of Chad's picks here? Gap, you have something on this?
Yeah, you know, I've been looking at the stock as well recently, and the company did actually sort of saw a flip-flop in its most recent announcement when it said its same-store sales were stronger than expected, but its earnings were looking a little weaker than expected. The stock, however, has done a little bit better this year, in part because of takeover speculation. H&M, the latest company that's been mentioned in reports. So, Chad, I guess my question, I mean, I have a lot of questions about Gap, but if we don't see some kind of acquisition, isn't some of the air going to come out of the stock? I mean, not that it's up that much, but are we going to see it come down?
No, I don't believe so. Actually, I think that what they'll do is accelerate their share repurchase program. And this company could purchase about 25% of their outstanding shares in the next 3 to 5 years. So what you'll get is a free cash flow that will continue to rise per share, and they'll be very aggressive and just reinvesting back into their company.
What about the fundamental business, though? I mean, again, if you're seeing the top-line growth, that's great, but if the margins are being compressed by the increase in cost that we have seen, isn't that going to be a problem?
Well, operating margins haven't been compressed drastically. So they took their operating margins from 8% to 12%. And if you shed 1% off of operating margins, you still are getting a really, really terrific value. And keep in mind that this company could either be taken over by a private equity firm or a partner like H&M, or they'll just continue to buy back their shares. In the next 5 years, you're going to have a terrific return.
Chad, I want to shift gears here just a little bit to healthcare, because the NFIB numbers show us that uncertainty about what's going on in Washington is starting to climb again. And, of course, healthcare is never an issue that you can really be certain about with the Republicans controlling the House. Why do you like healthcare?
Well, I think that you have the dark clouds of the health care bureaucracy now moving away from the industry. So the companies that I favor in that industry are WellPoint as well as Humana. I think that they're growing, they're profitable, they're well capitalized, and you're going to see operating margins continue to improve as well as the top line beat.
Well, it hasn't been a bad pick this year. The stocks have done nicely. Suzanne, you're taking a look at these healthcare returns?
Yeah, and Chad's picks are all at 52-week highs today. And interestingly enough, we heard from JP Morgan actually turning more positive on the healthcare sector as of today, even though the returns have been a lot better than the S&P this year. We've got biotech up 15%, healthcare up over 14%. Chad, my question for you is when you look at the dividend yields on your picks for WellPoint and Humana, the dividend yields are actually below what the sector is paying. Are you expecting these companies to perhaps shell out more dividends? That was part of the JP Morgan call today.
Well, that's a terrific question. What you see there is you have each one of these companies have a free cash flow multiple that is trading around 8 or 9. So they can certainly pay out an excessive amount of dividend over the course of the next 18 to 24 months. So they can get their dividend yields up to 3% with no problem and continue to invest into their business.
What do you think about large cap tech companies? I noticed IBM and Hewlett-Packard are a couple of your picks. Everybody talks about tech. Everybody talks about moving into the big quality names, but it doesn't outperform.
Well, it hasn't over the last couple of years. You've had small caps and mid caps outperform. But I think there will be a rotation into technology companies, in particular IBM, Hewlett-Packard. They have a high return on invested capital. They're growing on the top line. They're profitable. And also, they have free cash flow yields that are in the range of 7 to 8%.
Sheila, you've been taking a look at the tech trade. It's not having a fantastic day.
Yeah, certainly not having a fantastic day. Hasn't had a great couple of months either. Certainly tech led us out of the recovery, but it's been lagging as of late. Chad, I want to hone in on Hewlett-Packard. I know you're bullish on the stock. The stock has really underperformed lately. You know, you see a lot of company-specific issues like the Sandy Bridge recall, obviously Japan's supply chain. But even beyond that, though, more and more signs of a soft PC consumer market. Forecasts really across the board are coming down. Why are you still so bullish on Hewlett-Packard?
You know, this company reminds me of IBM back in the mid to early 90s. You have a very low margin type of business. They're transitioning their business mix to a higher margin business. Internally, they can create that through the software acquisitions externally. And I believe that if you are a patient investor, over a period of time, you're going to be handsomely rewarded.
So it paid off in IBM.
Excuse me?
I said it certainly paid off with IBM recently hitting record highs.
Indeed it has. Indeed it has. They've taken their operating margins from 10% over a glacial period of time, a long period of time, up to in excess of 20%. And IBM has done a heck of a job. And
I was going to say the same thing. Who doesn't want to buy the next IBM? Chad, thanks so much for joining us. Chad Morganlander there from Stifel Nicolaus.